Welcome, everyone, to How to Consolidate Business Debt. I'm Jerry Detweiler, Education Director for NAV.
And I'm Ty Kiesel, Content Director for NAV. It's great to be here.
We're excited to talk to you about debt consolidation because when it's done right, debt consolidation can be very beneficial to your business. The perfect scenario or the perfect trifecta of debt consolidation is when you're able to get lower payments, so the debt is more affordable. You get lower interest rates, so you pay back less money over time to the lender, and ideally you get fewer payments. I think most business owners would love to get down from, say, 3 or 4 payments down to 1 payment. Sometimes that may not be possible, so sometimes you may consolidate a couple of debts but not another. So this is the overall goal, but keep in mind that you have to be realistic, and sometimes you don't get the perfect world of debt consolidation, but you can get closer to what you would like to achieve. And that's what we're going to talk about today. We're going to talk about the types of debt consolidation loans that are available, the types of financing that may be available to consolidate debt, how to qualify, and how to make the right decision for your business.
There are a bunch of things to kind of consider. Over the last 10 years, a lot of small business lending, online in particular, has included short-term loans with daily or weekly periodic payment schedules. Now, this is not a bash on those loan products because they serve a purpose and they fill a lot of needs, but they are not a end all be all for every small business loan purpose that you might have. So if you have, for example, 2 or 3 of these daily, weekly payment type loans, it might make sense to consolidate them into one loan with one interest rate and one monthly payment. But you need to look at the pros and cons. For example, some of the pros are pretty obvious. You can reduce monthly payments into a single payment. It could make budgeting and bookkeeping easier because instead of a daily debit coming out of your business bank account, it's a monthly payment, and it could be easier to budget. It could be easier to do the bookkeeping. And there's also the possibility that you could, by lowering your interest rate and lowering the payment frequency, you could lower the monthly debt obligation that you have as far as periodic payments are concerned. Some of the cons, some of the things that you need to think about is the new financing could be more expensive. It could carry with it a higher interest rate. The interest or fee portion of the advance will more than likely be rolled into the new one. Some of these shorter term loans, the prepayment penalty, if there is such a thing, is that the interest and fees that you were going to pay if you made all of those payments will still be due even if you pay the loan off early. So you just need to be aware of that. And every lender does it a little bit differently. So you're going to want to confirm with your particular lender how they treat those fees or any unpaid interest should you repay the loan early. And the last one is the slide says it may result in a new UCC filing. You should expect that it probably will. The lender is going to file a UCC filing with the state where you do business to let other lenders know that you have a loan with them. So the cons may or may not be a big deal for your particular loan. You're going to need to investigate that and ask your lender how they treat those things. But there are definitely some pros. And you need to look at that when you're refinancing. We're going to talk a little bit more about that now.
Yeah, and Ty, I'll just jump in and add a couple points here. One is on the cost of this financing. It's important to remember that small business lenders generally don't have to provide an interest rate or an annual percentage rate, an APR. And that's what we use in the consumer world to shop for mortgages or student loans or credit cards because it's required by the Truth in Lending Act. It's not required on the business side. So sometimes it can be confusing to to understand the costs that you're being presented, if it's presented as a fee or a factor rate or something that's not familiar to you. So we do have free calculators at nav.com/calculator, and those don't require any personal information. You can use those to translate the cost of financing you're considering into an APR to get an idea of what you may be paying. And then on the UCC filing side, this is really important because the UCC filing is just a notice in the public record, which means it's filed with the courthouse, and it says, I the lender have interest in the property of this business, and here's the property of the business that I have a security interest in. They want to be first in line if you don't repay it. Too many UCC filings can sometimes get you turned down for additional financing. So one tip I'll have is check your business credit before you're applying for financing and see what's on there. We found at NAV, we help business owners check and monitor their business credit for free from the major business credit bureaus. And we found that some financing companies are great about placing the UCC filing. They aren't great about updating it when the financing has been paid back. It should say that it's been released or satisfied when it's paid back. So that's something you want to definitely double check if you're looking for some of this financing.
Yeah, you should assume that they're not going to automatically remove the UCC filing when you paid the loan off. So you're going to need to request that. And one other thing we probably ought to talk about, it's in the pros column, but reducing your monthly payment frequency from daily, weekly to monthly doesn't necessarily mean that your monthly payment obligation is going to be reduced. So take, if like let's say you have 20 payments every month of $100, and you want to make sure that those 20 daily payments do not equal less than what the single monthly payment will be, because that would definitely increase the monthly obligation that you have and could potentially impact your cash flow. So you just want to make sure that you look at all of the numbers associated with the loans, because a daily or a weekly payment frequency doesn't necessarily mean that it's going to be more expensive every month. It could, and it often does, but that's something you're going to want to make sure of.
Yeah, good points. All right, so let's talk about how to get a business debt consolidation loan. At NAV, we're encouraged. We're talking today as we're starting to see the economy begin its recovery from the pandemic crisis, and we're seeing the lenders are lending again. This is how lenders make money. This is their business, and they want to lend to qualified borrowers. And so we've been enjoying the fact that we've been able to help some small business owners consolidate their business debt successfully. And so we'll talk about some of the products that we're seeing that happening in. But where I'd like you to start is by doing an inventory of your current debt. Now, you may already have a schedule of debts that could be printed out from your accounting software, but if you're like most business owners, you probably don't spend a lot of time in there. And so you probably need to sit down to take the time to do this, but I can't encourage it enough. This is really, really important if you want to be successful in debt consolidation. So, make a list of those debts that you owe. How much do you owe? How much do you owe to each of those lenders or financing companies? And what's the name of the company that you owe it to? Is there any collateral involved? Because a lender will have an interest in that collateral that will impact the UCC filing, and it could impact other, financing that you get. What are the repayment schedules? How often do you have to make payments? How much are those payments? How long do you expect to make those payments? And then the interest rate, or the amount, the cost of that financing. Now, it can be tricky because you may not have an interest rate from your lender. You may have a fee. You may have a factor rate. So use those calculators, nav.com/calculator, to try to get an idea at least of what the interest rate is that you're paying. So that way, when you're looking at another option and you're comparing it, you can see how it compares. Over the years, Ty, you and I have both talked to so many consumers and business owners, and it is not unusual for me to hear from someone who's just worn down by their debts and by their payments. And so when someone comes along and says they can consolidate it, they say, great, without really understanding the long term cost or implications of that. So we want to help you make a smart decision. Now, before we go into some specifics, I do want to mention that what we're talking about here is debt consolidation financing. You may also see on the internet or on advertisements debt consolidation that isn't really debt consolidation. It's more help with your debts. So it might be for credit counseling where they help you pay your debts back to your creditors, or it might even be for something called debt settlement or debt negotiation where you stop paying your debts and then they try to settle for pennies on the dollar. That's not what we're talking about here. We're talking about true debt consolidation, which involves taking out new financing to pay off prior financing. And so it's that's what we want to explore here.
And the idea of making a list of all of your current debt is not just an exercise for you to calculate what the costs are that you're currently paying, because you are applying for new financing to consolidate those loans. It is likely you should expect that any lender will want to know what those are. And if you decide that you're not going to be forthcoming and you don't talk about the loan to ABC Cash Advance, it could cause your loan application to be rejected. So you want to be as complete and thorough as you can and share this information with your lender if they ask for it, which they probably will. And then you need to evaluate, what do you qualify for. The fact of the matter is, to consolidate those daily weekly payment loans, for example, into a better situation for you, you need to consider that a lot of those short-term daily weekly payment loans were geared towards people with less than perfect credit profiles. And so the better your credit profile, the more successful this process is going to be, because basically what we're talking about is um, lower cost financing in most cases than what you currently have. So you're going to want to look at your personal and business credit scores. If you've got a 600 or a 550 personal credit score, some of the options we're going to talk to you about today won't work for you. You need to be at least 650 or better. And some of these lenders are going to want to see, in the 700s. So if you have been if you have wisely invested the last few years trying to improve your credit profile, that's going to be good for you, but you should know what they are. This is another place where NAV can help you. You can go to NAV and for free get your personal credit score and your business credit scores and look and see where you're at now before you apply. They're also going to want to have an average monthly revenues for the last 6 months. So you're going to need to know what those revenues are. And when I say average monthly revenues, I'm not thinking in terms of, well, the last couple months we've done X amount of revenue. So I think that's the average for the 6 months. They're going to want to see this information validated by your business bank statements. Don't try to fudge here. You're not going to get away with it if you do. They want clear, straightforward documentation that is going to describe the last 6 months of your business. Now, even if it's less than ideal, lenders are understanding in many cases if you can explain why. And so, just make sure that you give them the most accurate information you can. What's the age of your business? Some of these loans are restricted to businesses that have been around for a couple of years. So if your business is 6 months old, some of these options will probably not work for you, but they're going to ask you about the age of your business. Some lenders are going to be interested in the invoices that you have outstanding because they will use those invoices to secure financing for you. So if you have a good idea already of what your accounts receivable is, that could help you with some of these options that we're going to talk about. And also, if you have collateral, collateral can benefit you in this instance because we're looking at longer term financing, likely lower interest rates that will reduce your monthly payment obligation, not just the payment frequency. So, you want to make sure that you're in a position where it actually makes sense for you to go in and apply. And if you're not, it kind of gives you a, a list of things that you can start working on. So 6 months from now, you'll be in a better position to apply.
Yes, agree completely. So then once you've taken that inventory, you know what your debts are, you understand your qualifications, then you're going to look at what's out there for you. And it depends on really the lending product, what they may be willing to lend. There are some products that we work with lenders with at NAV where it can go up to 250% of your average gross monthly revenues. Some of them, a lot of them their sweet spot is between 50 and 100% of your average monthly gross deposits or revenues. But there's a variety of products out there. And so we're going to get specific about these in just a moment, because I think one thing business owners don't always understand is that your bank is not the only place for small business financing. And in fact, for many business owners, the bank is not the right fit, not because it's not good. If you can get a bank loan, great, but because banks tend to be very risk averse and pretty conservative in their lending. So they usually want the cream of the crop, the top tier borrowers, and someone who is trying to get debt consolidation may not fall into that category. So we want to go through some products and help you understand what might be available. Please don't feel overwhelmed, because at NAV, this is what we do all day long, is help match borrowers to financing. What we're trying to do in this presentation is open your eyes so you can see what's out there. And then through the NAV platform, we can help you understand what may be available based on your qualifications.
This first option, this multi-year term loan option, is probably my very favorite option for this. If you have 2 or 3 short-term loans with daily or weekly payment obligations, and it's been weighing you down because you're every day there's an automatic debit coming out of your account. This is a really good option, provided you have a good to excellent credit profile, because the interest rates they're probably not equivalent to the bank, but instead of waiting 3, 4, 5 weeks to a month or two to get an answer, you can get an answer relatively quickly. And it's going to be competitive within 2 or 3 interest points of a bank loan. And it's a great way to consolidate some of these smaller loans into one loan. Over the course of the loan term, it's the way interest amortizes, you may end up paying a little bit more in cost of financing, but the interest rate will be less and your monthly payment obligation would be less. This is a
Yeah,
good
and
way.
Ty, let me jump in here and just make sure that we define a term loan. So anybody who's not familiar with this particular terminology, a term loan is a fixed amount of money for a fixed period of time.
Yes.
So you may borrow, for example, $25,000 and pay it back over 24 months, 24 monthly payments. The interest rate could be fixed or it could be variable. It depends, but you really know what to expect. And I think that's one of the beauty of term loans, is that you can budget it out. You know when that loan is going to be paid off. And a lot of the lenders we work with these products don't have a prepayment penalty. So, hey, the economy's picking up, your business starts to boom, you pay it off early, great. Then, it's done. If you need the time to pay, then you can pay it off over whatever term you're approved for. I agree, though, Ty. This is one of the products we really like at NAV, and our customers, the business owners, really like, because they give them that predictable payment.
Yeah, it's a great product for qualified borrowers. It's not something, if you have a a really poor credit profile that you'll be able to qualify for. The next thing on the list is commercial mortgage refinance. And this is if you've got a warehouse or a storefront that is yours, this is another good option because it's going to likely be collateralized by the real estate and the interest rates will be lower. And it's a good way to refinance some of the shorter term type financing that can be more expensive, provided you've got a piece of commercial real estate that is worth more than what you owe on it, and is and your credit profile is reasonably good. This is another great option. And the last on this particular slide is accounts receivable financing. And I like to describe it this way. We have two bakers. One baker sells donuts out of a storefront on the corner to people going into the office every day. It's a cash business. The other baker sells eclairs to the 10 biggest restaurant chains in their area, and those restaurant chains all pay via invoice every month. Depending upon the value of that accounts receivable, you could use that to secure a small business loan to consolidate some of your other debt. Now, this is a little bit different than factoring, which is another accounts receivable financing option. Factoring is you're basically selling your accounts receivable to a factor, a third party, who is going to then collect from your customers, where the type of accounts receivable financing we're talking about right now is a loan based upon your accounts receivable as securing the loan. So basically, they use your accounts receivable to validate that you have enough income coming in to make this periodic payment, and you will continue to bill your customers as you did in the past.
Yeah, and that can be very attractive for anyone who's doing business with other businesses. So like
Yeah.
that eclair baker, you're doing business with other businesses. Equipment refinancing or equipment financing, both can be options here. So if you have equipment that you own free and clear, or you have a lot of equity in it, then that can be tapped for debt consolidation. Now, I will say that the lenders we work with at NAV tend to look for larger collateral plays here. So $300,000 or more, for example, in equity in a equipment would be a threshold for many of the lenders that we work with, at least when we're working one-on-one with borrowers. There are some online lenders that are more flexible that will take smaller deals in this area, but it's certainly something to consider and think about. There's another structure too where you can actually work to lease back the equipment. So you're essentially leasing it from yourself, but turning it into cash, and that's another structure that can be used for debt consolidation. Now, credit cards are something else to consider, and I know that there's a lot of fear around credit card debt because it can be a hole that can be tough to dig out of. At the same time, when we look in terms of fast financing, credit cards are often at the top of the list because once you're approved for that credit card, you spend it however you want up to your limit, and there's nothing else you have to do. Now, to get cash out of a credit card to consolidate debt is a little more tricky because if you go to your bank and say, I want a cash advance against this credit card, you're probably going to pay what's called a cash advance interest rate, and that's going to be pretty expensive. So instead, what you may need to think about is one of two strategies. One is using the credit card to finance things you're already paying for, so you can free up cash to pay off other more expensive debt more quickly, or a balance transfer, where you can use a balance transfer to pay off other more expensive debt. And we are seeing at NAV that credit cards are coming back, especially both personal and small business. But we've really been keeping our eye on the small business credit cards because when the pandemic first hit in March of 2020, a lot of the business credit card issuers just stopped. Stopped marketing to new customers. Some of them froze credit lines. A few of them dropped credit lines. Not as bad as it was in the 2008 financial crisis, but we did see some of that going on. Now they're eager to get back and lend to small business owners. They're anticipating an economic recovery and they want you to use their card, as your business begins to recover. So there's a lot of competitive offers out there. So this is something you can consider. And one thing I like about this type of consolidation is that you will, with a business credit card, get an APR. They will tell you an annual percentage rate. They'll express the interest as an APR. So it's very easy for you to see how much you're paying. It's very clear and straightforward. You're not going to see some terminology that you're not familiar with. And then the last thing I'll touch on here is SBA loans. So this is a very big category, and we can do a whole presentation on SBA loans. But many of you are familiar with SBA loans because of PPP and EIDL, those two programs, the Paycheck Protection Program and the Economic Injury Disaster Loan. Both are great loan programs. The EIDL is still available. At this moment, PPP is closed to new borrowers. The SBA is still processing applications that were submitted before the deadline for PPP. The EIDL loans are available at 3.75% for up to 30 years. However, they are not meant to be used to refinance long-term debt. So according to the operating procedures, SOP for disaster loans, you can use those to pay short-term debt. That would be an example, would be a credit card or a debt, probably for a year or less, but they're not supposed to be used for long-term debt. So you may still need to use your other vehicles for that. Now, beyond those two programs, the SBA normally doesn't do they do disaster loans, but they don't do a lot of these types of loans. PPP was just created for the pandemic. Instead, what they do is they partner with financial institutions who make SBA guaranteed loans. So the SBA is guaranteeing the loan, but it's not making the loan. Those loans are growing still. It's still a very popular option. There's a big alphabet soup of names for these loans: 7A loans, 504 loans, there's express loans, export express loans. But some of these loans available through SBA approved lenders can be used to refinance debt. Not all, but some of them can be used to refinance debt. And if you do, I can tell you that you're probably going to get very favorable terms. May not be as cheap as the bank loan that if you could qualify for, you'd get directly. But SBA loans are really designed to fill a gap for people who don't qualify for that best interest rate bank loan, instead need a little help from the SBA. So keep this in mind. We do at NAV partner with SBA lending partners to help you identify those opportunities. And we also have a free e-guide about SBA loans that can go into more detail about the different types that are available. One more tip before I leave this topic, and that is that the SBA for each of these SBA loans sets a minimum standard for approval. And typically they say good, acceptable credit is required. They don't usually have a minimum credit score except for certain loans where they use something called a FICO small business SBSS score. But the individual lender can have their own qualifications. So your lender could say, well, we don't want to lend to a business where the owner's credit score is less than, say, 680 or 700 or maybe even 720. And so the takeaway here is, if you go to your bank and they say, we can't give you an SBA loan, it doesn't necessarily mean you can't get an SBA loan somewhere else. It may, if you don't qualify at all, you don't meet the SBA's size standards, for example, or the business is not based in the US, you won't get one. But it may just be that lender. So I just want you to keep that in mind, that it's kind of confusing because we think of the SBA as the place to go, but instead the SBA is partnered with these lenders around the country to make these loans, and that may be an ideal opportunity for you to consolidate debt. Anything you want to add on those three options, Ty?
Jerry's absolutely correct about SBA lenders. In the city that I live in, every year toward the end of the SBA's fiscal year, the two biggest SBA lenders in my town, they vie to be the one that does more SBA lending than anybody else in the state. So not all SBA lenders require the same credit profiles. However, that being said, if you have a 500 credit score, you're not going to get an SBA loan. And so if you've got reasonably good to great credit, an SBA loan is going to be one of the lowest cost options for you, and it's worth applying. Um, I love the SBA and what they do. Their mission since I think it was like 1957 has been to fill that gap between what a bank would lend to and what small businesses need. So they're a great option. Now, the next item on the list is short-term to mid-term financing. Most of the stuff that we're trying to consolidate is going to be short-term, mid-term financing. However, not all short-term financing is created equal. Some are more expensive than others. And so you need somebody who can kind of help you navigate what is a good way to refinance your cash advance loan with another short-term financing, because some lenders are better than others and cost less than others. So this is another option that is worth considering. Then there's home equity. Now, I've owned my own small business a couple of times, and I leveraged home equity to start one of those businesses, and it is a very, very, very risky proposition. The reason being is you're putting your home at risk when you use home equity to finance business operations. So make sure that it's what you really want to do, and that in my opinion, I don't know that this is necessarily the official opinion at NAV, but in my opinion, that is one of the financing options of last resort. I would not recommend it for all but the surest of deals, because you're going to be stuck with the increased house payment for the rest of the term of your home loan. And so you just want to make sure it's money that's available to you, but it's risky money, and so make sure you treat it that way.
Yeah, Ty, I'm going to add that I agree, because home equity and retirement funds are both options that business owners will tap for small business financing, for growth, or for debt consolidation for their business. And with both of them, starting a business or growing a business, running a business is risky. And when you combine that risk with the idea that, you might not have enough money for retirement, or you might potentially lose the roof over your head, that adds a lot of stress for the business owner. So I would agree that this is something you'd have to approach very, very cautiously and feel very confident in terms of your ability to repay that loan.
Another thing about home equity is it's very possible that you could um, be asked to put your home up as collateral on a longer term loan, or the SBA, for example. They don't necessarily require that you fully collateralize your loan, but they will require whatever collateral you can provide in some instances. And I was speaking with a borrower a few years ago who had defaulted on his SBA loan. He had used his home as collateral, and the SBA was now moving to foreclose on his home, and he was really upset about it. And I asked him, I said, you signed the home office collateral, right? And he said, yes. And I said, that's what collateral's for. It's to mitigate the risk to the lender. So when you put your personal property like that up, whether it's in terms of borrowing against the home equity or as collateral for another loan, just make sure that you are doing it eyes wide open, because it is very risky.
Yes, and then the last option that may be possible is microloans. So if you have a smaller amount of debt, but it's still really, your business is really struggling with it, you may be able to get help through a nonprofit lender. Microloans are usually made by what's called community development financial institutions, or CDFIs. And we've written extensively about CDFIs on the NAV blog. And these are nonprofit organizations that are usually trying to help spur economic development in a particular part of the country, a geographic area. And often they work with underserved borrowers. So it might be women-owned businesses or minority-owned business or veteran-owned businesses, etc. These can be a little bit hard to find because they're nonprofit. They're not out there advertising and marketing like big for-profit lenders would, but they also can be more flexible than other for-profit lenders because they aren't there trying to maximize their profit. They're there trying to help the small business and in turn help the community in which that small business is located. So it doesn't mean that if you have terrible credit and you don't have a solid business plan that they're going to be able to help you, but if you have some circumstances that led to your credit problems, and if you are working to really grow your business, you may be a candidate for financing through one of these organizations. So a couple tips on how to find them. First of all, if you just go to nav.com/blog and put in microloans, put in CDFIs for community development financial institutions, you're going to come to a couple of articles that will go into detail about these types of loans and where to find them. The other thing you can do is contact your local SBA resource partner. So this would be something like SCORE or the Small Business Development Center. These are organizations that provide free mentoring and education to small business owners. And they're often attuned to what is available locally in terms of this type of financing. Ty and I, for example, are going to be doing a webinar soon for the New York SCORE, a New York SCORE chapter, and one of the presentations will come from a CDFI that's making loans, in a particular area in New York. So you have to do a little bit digging to find these, but the interest rates are often quite good, and again, they're more flexible than what you might find with a traditional lender that is more risk adverse and trying to maximize profits.
Does it make sense for you to consolidate? It might. It also might not. And so you kind of need to sit down and run through the numbers and go through exactly what that's why we started off with evaluate your current debt, evaluate your credit profile, make sure you understand how your business is doing financially. Compare all the existing debts, the payments, and the interest amounts or the fees or the costs associated with that, with consolidating those options to determine whether or not it's actually going to save you money or not. And just because you're consolidating a weekly payment or a daily payment into a monthly payment, don't just assume it's going to save you a bunch of money. It might free up cash flow, which is a win, but you want to make sure that you're comparing what you have now with whatever the options are, and then look and see, are there other issues that you need to address first to better position your business? Like I said in the very beginning, the better your credit profile, the better the option you're going to have, and the better the savings you're likely going to have when you go to do this. So, make sure that it makes sense for you before you sign on the dotted line and make this a reality.
Yeah, so let's recap and let's give you some tools and tips to implement what we've talked about today. So first of all, at NAV, we are a marketplace, not a lender. So we work with multiple lenders and financing options around the country. You can set up a free NAV account. It's safe and secure, and we don't sell your information to lenders so that you aren't going to get barraged with phone calls from lenders because you've signed up with NAV. What we'll do is we'll use your data. And remember, Ty talked about how important your data is to these lenders. We're going to use your data to help match you to lenders looking to make loans and offer financing to businesses with your profile. So within NAV, you will see options for you if they exist. Now, if you aren't seeing matches, if you're confused, if you don't understand what might be out there, we do have a team that'll be happy. You can set up a time to talk to our credit and lending team to understand your options. And then when you see something that's of interest that you think will help you in your debt consolidation, you can reach out to our team and we'll be happy to walk you through those options and, if necessary, help you complete the application process. Some of the lenders we work with are fully 100% online. You just fill it out online, you get a decision, you get the funding deposited in your bank account. Some of them, there's more back and forth involved because they might be larger loan amounts, for example. And then our funding team can work with you to help you get that application in. But our goal really is to help you understand what's available, help you become better qualified. So wherever you are right now, we want to get you that next step. So as you continue your growth in your business, you qualify for better and better financing. Ultimately, that's going to help your business be more successful and grow and get better financing. So that's what we want to do. So if you don't have a NAV account, sign up. Again, it's free. We're happy to help you and happy to answer your questions as you look at the matches that you see. Anything else you want to add, Ty?
Yeah, just don't feel like if you couldn't qualify for anything else a few years ago, that's still the case. If you've been working to improve your financial position, there are probably additional options available to you that you should explore. And, it's going to require you to evaluate your current situation with a future situation, but it'll be time well spent.
Thanks everyone for joining us today. We have more financing and small business presentations on the Bright Talk platform and on our YouTube channel and in many different places. So please feel free to check those out. We hope you found this helpful, and we welcome your questions. And most of all, we want to help you be successful.